Welcome to the Deep Dive, where we cut through the noise and pull out the essential insights you need to be truly well-informed. Today, we're plunging into a topic that can often feel, well, a bit like financial alchemy: stock dividends. We're going to demystify exactly what they are, explore the strategic reasons companies choose to issue them instead of, traditional cash payouts. And most critically, we'll unravel the specific accounting entries that reveal their true impact. Our mission: to transform what might seem like confusing financial mechanics into crystal clear, actionable knowledge for you.
And before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, definitely visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material.
Okay, so let's unpack this. When most of us hear dividend, we immediately think of cash, right? A company writing a check to its shareholders, usually coming from their retained earnings, basically, the profits they've held onto over time. But with a stock dividend, we're talking about giving out more shares of ownership instead of cash. So the big question is, why? Why would a company choose to do that? Why hand out stock when they could hand out cash? It feels different.
That's exactly the right place to start. The primary motivation for a company to issue a stock dividend instead of cash, it really boils down to one critical thing: preserving cash. Preserving cash for internal growth, for operational stability. Think about it. A company might be making good profits, but maybe that cash is already earmarked for something important.
Like what? R&D, buying new buildings.
Precisely.
Right.
Funding research and development, purchasing new property, plant, and equipment, maybe expanding operations.
Yeah.
Or just needing a solid cash cushion for day-to-day stuff, liquidity.
Right. So it's strategic. They're basically saying, hey, shareholders, we value you, but we need this cash right now to grow the business, which should benefit everyone long term.
Exactly. And the key mechanism here: when a company declares a stock dividend, there is zero cash outflow, absolutely none. And unlike a cash dividend, which creates a liability, a promise to pay a stock dividend creates no new liability, what shareholders get are just more shares, proportional to what they already own. They don't pay anything extra.
Okay, so if I own, say, 10% of a company.
Right. Let's say it has 10,000 shares outstanding, so you own 1,000. If they issue a 5,000 share stock dividend, you get 10% those new shares, so 500 more shares. Now you own 1,500 shares. But here's the crucial part: the total shares outstanding are now 15,000, so you're 1,500 shares, still 10% ownership.
So you get more pieces of the pie, but the pie itself is just sliced thinner. Your overall ownership percentage doesn't change.
Exactly, which is a perfect lead-in to the accounting impact.
Yeah.
Because if no cash leaves and there's no new debt, what actually changes on the balance sheet?
Oh, what does happen?
Well, what's fascinating and maybe a little surprising is that stock dividends don't affect total assets or total liabilities. And importantly, they don't change the total equity of the company either.
Really? Total equity stays the same.
Stays exactly the same. What happens is more like an internal adjustment, a reshuffling within the equity section. Specifically, the retained earnings account goes down, and the common stock account, and sometimes other contributed capital accounts like paid-in capital, they go up.
Okay, so it's like taking money out of your savings pocket, retained earnings, and putting it into your checking pocket, common stock paid-in capital. It's all still your money. The total hasn't changed.
That's a great analogy. You're just reclassifying it. You're essentially saying this portion of our past profits is now considered permanent capital, part of the core stock structure. It changes the composition of equity, but not the total amount.
Yeah, okay, that makes sense. But now, this is where it gets really interesting, right? Because apparently, the size of the stock dividend makes a huge difference in how you account for it. It's not just one rule fits all. We have small versus large stock dividends.
You've hit the absolute key distinction here. Yes, size matters a lot. Let's define them. A small stock dividend, that's when the new shares being issued are less than, say, 20% to 25% of the shares already out there. So in the example from Farhat lectures, if a company has 100,000 shares and issues 18,000 new ones, that's 18%. Definitely small.
Okay, less than 20-25% is small, so large.
Large stock dividend is when the new shares are more than that 20% to 25% threshold. Using the other example, if that same company with 100,000 shares issues 35,000 new shares, that's 35%. Clearly large.
And crucially for anyone studying this or looking at financials, the company won't just label it small or large for you, will they? You have to figure it out.
Absolutely not. You'll get the number of shares outstanding, the number being issued in the dividend, and you have to calculate that percentage. Is it below 20, 25%, or above? And don't worry too much about the exact borderline, like 22%. Tests usually make it clearly one or the other. The reason this matters so much comes down to market perception and, well, expected impact.
How so?
With a small stock dividend, the general thinking, the assumption, is that it's probably not going to significantly tank the stock's market price per share. But with a large stock dividend, the assumption flips, issuing that many new shares is expected to have a noticeable dilutive effect, likely lowering the market price per share. And the accounting rules reflect these different expectations.
Ah, okay. The accounting follows the expected economics. That makes sense. All right, let's get into the mechanics then. The journal entries, debits and credits. The rules are different for small versus large, right from the very first step, the declaration date. Let's start with A. Accounting for a small stock dividend on the declaration date. This is when the board officially says, we're doing this.
Okay. For a small stock dividend, the rule is you debit retained earnings for the fair market value of those new shares you're about to issue. Remember, fair market value is what the stock is actually trading for. You're taking the market worth of those shares out of retained earnings.
Why fair market value here?
Because, as we just said, the assumption is a small dividend won't drastically change that market price. So market value is seen as the best measure of what's being distributed, economically speaking. Then you credit an account called common stock dividend distributable, but only for the par value of those shares. Par value is often just a nominal amount, like $1 or even less. It's a legal value, not an economic one.
Okay, debit retained earnings for fair value, credit this distributable account for par value. There's usually a difference there, right? Fair value is almost always higher than par.
Almost always, yes. And that difference, that excess of fair value over par value, it gets credited to another equity account, paid in capital in excess of par common stock, often abbreviated as AP.
Got it. So retained earnings down by market value, common stock dividend distributable up by par, AP up by the difference. Let's try the Adam Company example. They have 10,000 shares outstanding, $1 par value. Board decides on a 1,000 share stock dividend. So 1,000 over 10,000 is 10%. That's small. And let's say the stock's fair value is $6 per share at declaration.
Perfect. So the entry on declaration date.
Yeah.
Debit retained earnings. 1,000 shares times $6 fair value. That's $6,000.
Okay, RE down by 6K.
Credit common stock dividend distributable. 1,000 shares times $1 par value.
$1,000.
That's the temporary account, up by 5K.
And credit paid in capital in excess of par common stock for the difference. $6,000 minus the $1,000, so $5,000.
APS up by 5K. And if we look at the net effect on total equity, $6,000 decrease in RE offset by a $1,000 increase in CSKD and a $5,000 increase in APs, net change is zero.
Yeah.
Total equity is unchanged.
Precisely. Just shuffled around within the equity section. It's an internal capital shift. And what about B, accounting for a small stock dividend on the distribution date? This is when the shares actually go out to shareholders. Right, Adam Company has declared it. Now they physically issue those 1,000 shares. This part seems simpler.
Much simpler. That temporary account, common stock dividend distributable, has served its purpose. You just need to move that amount into the actual common stock account. So you, debit common stock dividend distributable, $1,000. That zeroes out the temporary account. And credit common stock, $1,000. This increases the permanent common stock account, reflecting the newly issued shares.
And again, just moving things within equity. Debit one equity account, credit another, total equity still unchanged.
Exactly. It's just finalizing the process. Okay, now let's switch gears completely to C, accounting for a large stock dividend on the declaration date. Remember, this is where the rules are fundamentally different because of that expected market impact.
This is the big one to remember. Large dividend means ignore fair market value, right? Use par value.
That's the absolute key. For a large stock dividend, you debit retained earnings only for the par value of the newly issued shares. And you credit common stock dividend distributable also for the par value. Notice what's missing.
No paid-in capital in excess of par.
Exactly. Because the assumption is the large issuance will significantly impact the market price, likely lowering it. So using the higher fair value isn't considered appropriate or conservative. Par value is used instead. And be warned, problems, especially on exams, might still give you the fair market value just to see if you know to ignore it for a large dividend.
Sneaky. Okay, so large dividend. Debit RE for par, credit CSDD for par. Simple as that. Let's use Adam Company again. Still 10,000 shares outstanding, $1 par. But now the board declares a 4,000 share stock dividend. 4,000 over 10,000 is 40%. definitely large. Let's say the fair value is still $6, but we ignore it.
We ignore the $6. Correct.
Yeah.
So the declaration entry for this large dividend is debit retained earnings, 4,000 shares times $1 par value, $4,000.
Okay, RE down forte, much less than the 6K in the small dividend example.
Credit common stock dividend distributable, 4,000 shares times $1 par value, $4,000.
CSDD up $4 and that's it.
That's it for the declaration. Retained earnings down 4K, CSDD up $4. Again, look at total equity.
Unchanged. $4 can move from one equity account to another.
Precisely. Very clean transfer based on par value.
Right.
And then, for D, accounting for a large stock dividend on the distribution date, it's actually identical to the small dividend distribution.
Oh, okay. So when Atom Company actually issues those 4,000 shares, it's the same simple transfer.
Exactly the same. You just clear out the temporary account and book the common stock. The entry is debit common stock, dividend distributable, $4,000. Credit common stock, $4,000. And that completes the process. Shares are issued, common stock is updated, total equity remains unchanged throughout.
Wow. Okay. So we've gone through the why, the what, the small versus large distinction, and the detailed accounting. But let's bring it back. So what does this all mean for you, the listener? Why should you care about these specific entries, this small versus large thing, if you're not, say, an accountant day to day?
That's a really important question. Because understanding this isn't just about, passing an accounting exam, though it's absolutely critical knowledge for students and CPA candidates. Connecting it to the bigger picture. It's actually vital for analyzing a company's financial health, understanding its capital structure, and reading between the lines of its strategic decisions.
So for investors or anyone interested in finance, it tells a story that goes beyond just the numbers on the balance sheet.
Exactly. Seeing a company issue a stock dividend instead of cash, that immediately signals something about its priorities. It tells you management is choosing to keep cash in the business, likely because they believe they can generate a better return by reinvesting it in growth, R&D, paying down debt, whatever, than by just handing it out.
It's a signal about their confidence in future growth, maybe? Or maybe a signal they're tight on cash.
It could be either or both. It requires more context, but it definitely shows a preference for internal funding over cash distribution at that moment. It also fundamentally shows that not all dividends put cash in your pocket. Sometimes it's about increasing your share count, even if the value per share might adjust. Knowing the difference between small market value accounting and large par value accounting also helps you understand the scale of this internal equity shift and its potential market interpretation.
So it really drives home that financial statements aren't just static numbers. They reflect active choices, strategies, a company's philosophy on managing its capital. Stock dividends are a clear example of choosing growth or cash conservation over immediate payout.
Couldn't have said it better myself. It gives you a much deeper lens to evaluate what management is doing and why. It's about understanding that deliberate choice to restructure equity internally, keeping the ownership percentages the same, but signaling a focus on long-term value.
That perfectly sums up why we wanted to do this deep dive. We've seen stock dividends are, well, a pretty clever tool for companies. Reward shareholders, keep your cash. And the key takeaway really is that accounting difference based on size. Small dividends use fair market value, reflecting minimal price impact, while large dividends use par value, acknowledging a likely dilution. It's logical when you break it down.
It is. It connects the accounting rules directly to economic reality, or at least the presumed reality.
Right. So moving beyond the mechanics, here's a final thought for you to chew on. Given everything we've discussed, that total equity doesn't change, but cash is preserved and share count increases, how do you think a stock dividend might be viewed differently? Say, by a long-term investor focused purely on growth versus someone who relies on dividend checks for income, even though the company's total book value equity is the same.
That's a great question. Different investors, different perspectives on the same action.
Definitely something to think about. If you found this deep dive helpful and you want to really lock in this understanding with more examples, practice questions, detailed lectures, all that good stuff, we highly recommend you check out farhatlectures.com. Professor Farhat has extensive resources, whether you're a student, CPA candidate, or just, curious and want to learn more. Thanks so much for joining us on this deep dive into the world of stock dividends. We look forward to exploring another fascinating topic with you next time.